So we're now at the seventh layer. This is price action. And while the rest of the videos that you've listened and watched have discussed price action, it has been all about context, location, trend, momentum, behavior. Now we're going to get further into the bars, the reactions. But I will say that throughout this video, if you go back through the previous videos, you will see me discuss the bar reactions at those key locations. And buyers and sellers tell a story at those locations by how they behave. If there's accumulation and they rip it back up, it tells you there was a buyer who saw that level. And if they sell it down hard and it breaks through support, you start to get the idea that it's bearish because bears are proving themselves at support, which is a key fight that they prove themselves at. So I'm going to mention something here so that we keep it real. I know people have these expectations that they think that just because they'll read the market like me, they'll automatically just print money, and it doesn't work that way. The housekeeping aspect, the self-control, the following rules, the being disciplined, the picking the easy trade is a lot more of the formula. Even the psychology, the believing you can win and taking trades without self-sabotaging yourself is so important. I think there are a few traders out there that have talked about how literally people are getting what they want out of the market. Soros, I think, said that everyone gets what they want out of the market. And it's kind of true. You can see people who can read the market but are still losing because they sabotage themselves. They don't take the easy trade, they don't do the homework, and then they jump and they wonder why they lose. But they know they're taking trades that don't meet the multiple reasons they should be. Now, some of your best trades will be losers, and that's trading. All of my tools, each one of them individually, fails on their own. They all have failures. But when you add them together as a group, they increase odds. Now, price reactions. These are the terms we're going to use when we discuss and explain price behavior. Reading price is a repetitious process of testing for reactions. That means we will go down to an area like support and we will test and we'll retest and we'll probe it. I sometimes talk about it like a child testing the stove to see how hot it is. And it is very much like that. There is a poking at something with a stick, and they poke, and finally they find the spot where you're not supposed to do that, and they jump away from it. And when they don't, and they keep poking, and nobody defends that spot, it shows the power of one side of either the bulls or the bears, depending on where it is. Now, I'll use the word held because a level, a reaction area, a trend line, a specific set of variables will hold. And when price tests them, it'll poke and test and it'll hold. And that's a sign that we have a reaction. Now, there's also breakouts. Now, Dan is an expert breakout trader, but you notice he deploys the use of it only when the market is good, he's in a good sector or group, it's a strong stock, it has high strength comparative to other names in the market, it's a leader. And that's because trading breakouts is rolling the dice without these other conditions. Breakouts fail. Breakouts fail more than they work. I mean, if we look overall in the market, most market periods are filled with trading ranges, and there are attempts to leave for months and they don't go anywhere. Well, that means that every attempt to leave that range was a breakout failure. What does it take to get out of that trading range? It takes an immense amount of aggressiveness. It takes, in the case of a breakout from highs, it takes bulls proving themselves at resistance. They have to stand up at the gates of the castle in front of them, and they have to hit volume and price action. They got to close strong. They got to hold up. They got to keep defending their recent supports, their lows, and push through the walls in front of them. in the case of a breakdown or a breakout to the downside, they have to get to support and they will often bounce off it, maybe even several times. And finally, bears will be so powerful they will push themselves through those gates and fight to break underneath. They'll need volume, they'll need lower lows and lower highs, they'll need immense strong bars to break underneath there, and they'll even need lower highs underneath the breakout point to prove that they're really holding it. Breakout failures are whenever they try to leave something and they don't succeed. And these are happening all day long. Every time we hit a trend line, you may be looking at that trend line thinking, let's see if we break out. I'm thinking one of two options. It's either going to attest to get above it, and then nobody's going to show up, which means it's a failure, or they're going to push themselves through and have to prove to me how strong they are that they're going to force me to have to consider it. So most of the time in the market, we're dealing with failures that occur. And that's why price doesn't leave an area. That's why we spend in the indexes for sure most of the time in a range. They're failing to break out on both sides. Now, a shakeout is simply nothing more than a partial success that gets ripped the other direction. That means you'll draw your downtrend line and price will break out past it, and it'll spend a whopping couple of bars on an hourly chart above it, and then poof, the buyers will disappear, the excitement will disappear, your smile on your face will disappear, and it will rip down the other direction. And it's because they're shaking people out and faking them into buying it. And now you'll get the swoon, you'll get the hard break, because now traders are fooled. They're faked in the process. So they shake them out of positions, they fake them out of reading things incorrectly. So I put those two together, but they're really two things. A shakeout can be used when, let's say, an uptrending trend line is tested, it breaks below, it attempts to crack it and really break that area, and it does nothing more than move right back over the trend line, and all those people have been faked. But it happens on both sides of the game. So bulls or bears, we're looking for those. It is very common that the most powerful moves in the market are the end result of some traders being screwed right before that. When you see a strong move in one direction, you've got to look at the chart. You will often see there's some kind of screwy shakeout or fake, something that happened. It'll break underneath a double bottom, and everyone will think it's going to fall apart, and they will rip it right back, which is called a triple bottom, but I really don't use them as much. But it'll fake underneath there, and then it'll rip the other direction. And when I realize that, I look for my tools to align some way to get in that, because I know traders are screwed, which means a powerful move can ensue. Kind of like the screw bars I showed you. The idea that it closes horrible and gaps up over that bar, leaving everyone trapped. When you do that, you get a powerful move. And I mention a failure because it's hard to call a lot of patterns a breakout failure, because many of the patterns strictly fail the way they're not supposed to behave. I explained before, if it's a head and shoulders and the right shoulder fails, it's going to generally take the head of the pattern. It's going to make a new swing higher high. Same as in inverse, it just takes the new low. So we know that patterns, all of these things fail. We need to be able to read the information. So these are the terms I use. Now, where do traders place stops? Some of your best reactions you will find in the market happen right after stops are taken. So I need you to think in terms of, where do you place your stops? Anybody who's done this even a year knows you try to place your stop under the consolidation. You try to place your stop under the double bottom, under the trend line. If you know where you place stops, I want you to think in terms of, you also know where most humans are probably placing their stops. And so know that the pros in the market, the computers in the market, the amazing PhDs are not ignorant to this fact. And just know when you're trading, you've got to think in terms of, this is a cat and mouse game. And if you place your stops in that area, maybe you need to plan for it, like expect the shakeout or expect a little test into that area and plan your trade accordingly so that you're not one of the people who gets ripped out right in time for it to shake out and reverse. The only way to do that is to read price. Now, people ask me on a day-to-day basis what it takes to trade the futures. And I want to repeat, when I'm trading the futures, I'm looking at multiple charts. The ES futures, S&P futures, the NASDAQ futures, in overnight 24-hour charts. I'm looking at the TNA or the Russell chart. I'm looking at the SPY and the QQQ because I'm using the ETF to see what real-time traders see. And I'm having to find signals and layers across 6, 8 charts, along with maybe a little bit of market breadth information, or maybe the highs and lows that are going on in the market. And I'm going to share what I see. But there's so many aspects to look at. That is harder to show you as the first approach. What I suggest is you start out with a stock and you do what I'm doing on the index. And in this case, I just want you to see there's 12 different individual dots for 12 reactions on this chart. And this is a daily chart on Z. If we had gone to an hourly chart, there's going to be just as many that happen over a few days. So price is constantly at a challenging point, playing a game with us where we have to figure out, is it going to be accepted here? Is it going to be rejected? Are we going to hold? Are we going to fake? Are we going to fail? Are we going to shake out? Are we going to break out? So depending on the area we're at, we need to ask the questions. Let me show you this chart. This is a descending channel. You'll notice you've learned what a downtrend line looks like, the red line. And you'll notice that there's a bottoming support line right here, and price goes underneath just slightly at number 1. Now, you have to be thinking to yourself, is it falling out the bottom, which anything's possible in the market, and you have to read it and say, is it holding or not? And if we notice the daily chart, the next 2 bars kind of stack an angle up, and it starts to respond, and by about here, I'm starting to realize they're holding it. Now, that doesn't mean it's a good trade yet. I would have to go to a lower time frame and find more tools and reasons than strictly because the last 3 days are telling me by the lows of the bars that somebody is seeing this. But this bar takes out this prior bar, and this bar takes out all these low bars, and it's telling you it sees this pattern low that we just saw. So the first reaction is positive. The next reaction, number 2, is price gets to the downtrend line, and it actually taps it, and you can see it doesn't go through that day or the next day. And then on this third day, you'll see right above my laser pointer, price breaks out past the trend line. Now, does it on volume? It's a nice feature that we get volume here that is confirmation that it sees it. That's what we want to see. In a perfect world, we would want volume to be 140% or more of average, what it does on a 20-day average. But in reality, that's more important the stronger the stock is and the higher up it is when it's trying to fight resistance that's heavier. Here, this was just one trend line, and there's not a huge amount of prior supports built here, so it could climb okay. Now, while price is climbing up here, we have a reaction, in which case we left our trend line behind and it breaks through and it's trending. This is kind of a rising channel if we notice. And interesting, you notice these last 4 bars at the top. Look at this, 1, 2, 3, 4 bars. It tries to break out of that little rising channel. It's actually rising. Look at the angle. It's kind of like lifting up. It's not a nice flag where it's descending, but it tries to break out, and the next day gaps lower and falls down. And it comes down to the trend line. It bounces off of it, and it lifts up. You can see the nice bar. It bounces back off it and then falls through and gets flat. So this is now a trading range and consolidation. We see number 3, that trend line did hold on the first attempt, but then went sideways. So it's less bullish. We're losing momentum, and we're now sideways. At point number 4, we actually see that price tried to break out of this lower consolidation, and it closed, the white dot closed back in the range. And the top of that bar was the prior trend angle of the uptrend line. Very common, retesting a prior supporting line as resistance. So it's less bullish right here. And price sits sideways. I see a head and shoulders. Left, draw the line across, right shoulder right here. No, it's not pretty. If we go to an hourly, probably looks better, but I see a weak pattern. It gets up to number 5 next, and that is the neckline of that pattern, or the support line. And we see a volume increase, although it's not massively noticeable. Price breaks through that support, and then it creates a double bottom, basically. One bottom, two bottoms undercut, and then starts to come back. So price is now trying to come back in the range, and we're watching, and it rallies back up, and we're back in the range, and we're thinking, that last weak signal didn't really amount to much. And now, at number 6, price finds a new support point. It's finding a new defense area. Number 6 reacts by holding that level. And we can see in each one of the candles, or bars, in this case bars, we can see responses. Look at strong bar gets up there. Next day, small little inside bar. This is actually called a harami. It then proceeds to hold there and fly up. And the next day, it can't go much further up here, and it falls back down. And the low of that day is right on the line, and the next day, it touches that line and launches all the way back toward the upper side. That's bullish. So it gaps up. That's even more bullish, confirming. And it pulls back, and it doesn't fully fill the gap, so we still have some momentum. It rallies up, makes a lower high, so this is not as strong at this moment, but it comes down and it touches it, and look at the bar. Huge up bar. It sees number 7. It positively sees that support area. Now, the next day, notice it retraces most of that move, and I just want you to know that bar was meant to take out anybody who thought the strong bar was just going to keep flying, and fear of missing out people, and it just shakes them. But it never undercuts number 7. Price rallies up to the top peak of this range. And number 8, the question is breakout or breakout failure. And in this case, price, I don't see massive volume at that point fully. Let me see. Yeah, there's some volume. And it breaks out and closes above it. And the next day it gaps up. We see momentum is happening. Now, at number 9, we look and we see that support is holding over the next several days tightly above this little uptrend line. We found new support. And at number 10, we see a descending line, and we're drawing our line up, but we're seeing a little descending line. And look how tight these bars are. This means tighter bars means our stop is tighter to try this. So we try our long off number 9 to 10, breaking out, and we think breakout or fake, breakout or fail. What's going to happen? And it breaks out, and we can see it's tight. The closes are tight. It doesn't take out the lows. Each bar is a higher low. It's nice and organized, and then gets to the top of the range. We draw our topping resistance line, and our TRL shows us the next few days' highs, in which case it falls back to the lower line. And here's where chat room is screaming, the stock is over with, it looks horrible, and telling you that, you know, you stink and it's not going to work. And it holds support perfectly, closes at the low, and everybody talks about the candles and the bars and says it's a terrible bar. But the next day it gaps open and the entire range is inside the prior day's range. There's no follow through. So at number 11, there's no success of being bearish. In fact, it rips back up to the top of the range again, where we get number 12, which is our TRL, our topping resistance line almost. And price then proceeds to pull back and continues to climb higher. Why? Because this trend was up. Now, I just showed you the kind of skill that I use to read every move that's going on in the market. And this is a real world example. This is not a pretty example. This is real including successes and failures, bulls winning, bears actually trying to take some control, losing control, back to bulls, reading how price moves. And if we go down to lower time frames, we see even more, which is why we don't start out with lower time frames. Testing and price discovery. Price discovery is the term I use for the process in which price tests the locations we have discussed up to this point. I don't believe it's chop. I know everybody calls it chop. Everybody uses the word chop. Chop is, in my opinion, a general way of saying I can't read it. If you're reading these discoveries, if you're seeing these reactions, and you're keeping score at each impasse, at each hurdle, well, then you're actually able to see that this is price testing to discover what it wants to do. We don't have to be surprised we can read it. When we can't read it, move on to another instrument because it's too difficult. That is really choppy if you can't read any discovery. If there's no discovery of each reaction to be read, price is too caught in a range that you can't read, move on to the next symbol. You're not going to be able to trade an edge in that case. That's when you can use the word chop because you can't read it. And I want to repeat this like a child testing boundaries. Any of you who have had kids have known your kids will test the edges of your boundaries in everything. What you allow them to watch on TV, what you choose for them to touch in your house, they will test your boundaries. Price moves from these locations to locations to test this acceptance or rejection at each one. Acceptance is allowing something to happen, and rejection is, holding and shooting away from it. So we see these discussions happen everywhere in price. Now, wide-ranging bars. I'm bringing this up because this is something that was horrible for me as a trader. I had the fear of missing out like no tomorrow. Every time the bar would break out, and it would be a big bar, my brain was telling me, you're missing it, you're missing it, you're going to miss the trade. It's running. And I want you to know, if you go back over time and highlight most wide-ranging bars, bigger bars than the rest of the bars, are ending bars. They don't necessarily start a move. Now, some of them do. Everything I say is wrong in some instances, but we're talking probability. Probability says that it also depends on where it forms. In the case of this first yellow box, price has run up to the top of the range. There's some resistance to the left, and it has a big move up and closes down and then moves down. This is a sign that there was in essence, they trapped buyers. This is rookies were chasing, and they trapped them. In this case, it finds support, price consolidates, tries to undercut support, and no follow through. This big bar down shakes out some people, and it's back in range. Does it again here. Shakes out some people, back in range, rips the other direction. Why? Because we screwed people down here. Same thing here. You see this gap up. We've got momentum. You get this big bar. The next few days are sideways doing nothing. I know you think it's going to keep going, but read price. Don't read your opinion. That is the point of this chart. This we discussed before, but I want to repeat it. Narrow bars, tight bars, equal lower risk entries. Why? Because the distance to find out you're wrong is smaller. So if you look at price near this first green arrow, and you see there are 3 daily bars that are tight as can be, like a flag. Look at 2 bars up, flagpole, and then sideways for 3 days. And they're tight as can be. When you enter on this, the price to figure out you're wrong, which is the little trend line underneath, or the little support point below it, is very small, which means there's tiny risk right in here compared to this big move up. And there wasn't that much to the left, let's say. So this provides a really good trade. Again, here, I don't like this one as much. I don't like this one as much for multiple reasons. Number one, the distance to the high is closer. So I don't have as much room. There's an actual swing. This one was kind of a consolidation. It's tight. So it held at the top of that range. This one, it pulled back and it actually rejected pretty solidly off that area. So I'm a little afraid that when it gets up to this point, it's going to have difficulties. And this one doesn't have the nice, tight, it has a little bit of an upward angle. A little bit. And I look at that and think, shorter time frame, maybe a rising channel. It may need to resolve down. That's me being picky. But again, we add up our conditions and create a trade. The condition on this chart that's important is tightness equals lower risk. And as long as it has the room for reward, you want to try to enter in an area where the risk is minimized. Now we're going to discuss breakouts, and even though this is not a point of the course, we need to discuss this reaction because it's a common reaction. This is probably one of the most misused reactions. Even people who follow Dan do not follow what a real breakout is. If you have not read Dan's Golden Rules, you need to read them. It is not good enough that a stock tries to break out. It needs multiple conditions for Dan to be interested in. It's got to have a market. It's got to maybe have a good sector. It's got to be a market with many stocks breaking out. You're not looking for the Lone Ranger to try to do what the others are not doing. If you read that book, How to Make Money in Stocks, you'll realize pretty clearly that the quality of a breakout has everything to do with finding success. In the case of BABA, this stock had a long consolidation. And I have to tell you, while it based, it had a few of my favorite things. What I like about the base here is while it was stuck in this consolidation, it shook out these times. In fact, the last time before it started to get strong, it really shook out. Why is that important? Well, I'm sorry to say, but without refueling in the consolidation, it has less pressure power to move up. I like that they had to screw a few people right at the end here before they started to get strong toward the top of the range. This is the screw fuel. This is the octane booster. This is the jet fuel that unfortunately is needed to power this out of the consolidation. So these perfect consolidations, when you say it's perfectly square and gorgeous, they're not really that great. The great one is the one that shows people getting wiped out first. And usually right after that is when it acts even better. Now traders get wiped out here. It gets to the top of the range. You'll notice there are two areas of resistance right here on this spike, but also they really resisted right here. You can see the rejections. It just couldn't get through it for months. Now notice when price gets up here, it rests and kind of flags. We've got pull and a flat kind of flagging behavior, tight consolidation sitting on this. And we even get clues of a flip. Resistance becomes support right here on those two bars. Now, when it tries to leave that range, look at the bar behavior. It closes at the high on that day after gapping out of the top, and it does it on huge volume. The next day, it gaps up. It does no movement. It's kind of sitting sideways, but it doesn't fall and the volume is big. The next day, it follows through with another move and closes even higher. This is momentum and power, and this is a clean breakout. You have proof from volume, you have proof from price, you have previous action before the breakout that show reasons for the breakout. You have a clean reason to look at it and say this is breaking out. And I love the fact that there are lows, bar lows, swing lows on a shorter time frame that are above the breakout point. Those are telling me when you have a higher low sitting on top of that resistance, there's a chance they're trying to flip it. And that's what I need. One spike over the top of those highs could be nothing more than a fake. And then the next thing you know, it goes straight down and traps all of those suckers. That's the goal for many breakout failures. Now here's Momo. This was a breakout Dan was looking at, and he called this. And I want you to see what happened. Here's one bar here where price tried to rally up and it fell right back in range. And you can kind of see there's a tight consolidation here. Shakes out to the low side. If you had drawn the uptrend line, this bar kind of scares you, which is good. I like that. And the next thing you know, it goes up to the top of the range where it couldn't get through. And volume powers up. And this really strong bar is confirmation that it's trying to break out and it's working because there's volume and price activity. Now, if it immediately falls back under, closes underneath here, and then falls lower, that's confirmation it's a breakout failure. But you can't always tell right near the breakout. You're looking for high volume, you're looking for solid price action. But even if it shakes out a little bit, you have to be able to read price and understand that pros know how to shake a few people. Now, this was a great breakout. It doesn't always work that way, but there are times where it fails. And on this same chart, I will show you a breakout failure. Now, when we move to failures, this was a live call in the chat room. I want you to know that everybody in the chat room was pretty excited about this one. Those are the people who didn't catch it at Dan's 16, 17 level now, see the stock at 25 and think, I have to own it. They don't realize that the higher the stock gets, the more volatility, the more risk, the stop could have to be wider, but they want it. And because they want it, there's a buying demand stampede from especially retail rookies. Now, notice price resistance levels here. Here's a resistance level. Here's a resistance level. Price fails at it. Here's a resistance level. Price fails at it. Notice we draw our downtrend line. And we have resistance here. Notice we have a bottoming support line where we create almost a channel here where price was descending. And then notice how price, after it undercuts this area here, it refuels and shoots back up, and it actually breaks this descending line. That's the first bullish clue. Now it holds above it, which is a double bottom. You can actually see the two bottoms there on a shorter time frame. That was a 2B. And it breaks the downtrend line. Volume is showing up on these waves. And so this is strong, and you actually have a breakout right here. So you enter and the breakout is working. When you get here, you already know there's a hurdle. So the problem with this trade is stop may have needed to be here, but this might not have been 5-1. And I remember I had to skip it. It wasn't 5-1. It didn't qualify. But price rallies past it. And at this moment, you have an entire room of people that are going, Momo's going, I'm going to miss the trade. And they're buying and ignoring all the rules. Now, they'll blame somebody else when they fail, but they're not accepting the rules. And the next thing you know, there's a sharp rising trend line, because remember, the steeper they get, the more they correct. And price just falls back. And I told people, while it was right up here, I said it's a $26.50 short, I believe, or $26 short. And the reason why it was a short is it didn't have enough power up here to prove that it wanted to keep going. If it was more powerful, if more volume kept coming in, if it had made a higher low above this red line and flipped it, I would have been happier. But I wasn't, and I didn't take the short. I just said, guys, for principle here, I'm going to show you if you short here, this is going to be a breakout failure. And the stock fell back. And this, I believe, happened twice on this stock. I'm not sure if I did it on this one and this one in chat, but here we go. It comes back to support. Look at last breakout support. It tests it again. You draw your descending line if you wanted to. Here's another breakout attempt. Price rallies up, creates a bull flag. Here's your pullback of your descending flag. You draw another resistance line. It breaks out, pops the top above the resistance, and then nobody's home. Nobody is home. Not volume, not price, no higher lows above support, and it falls over. That actually becomes the head. You now have a left shoulder and a head. Price now comes back down and you're thinking, this right shoulder area exists right here. This is not so good anymore. And that's when Momo started to pull back. So you can see this is a breakout failure. In order for a breakout to succeed, you need all of those factors on your side. You're asking for the stock to change composure, to do what it has not been able to do before, break through this area that has been a selling area. So in order to do that, we want proof. We want volume. We want price action. We want higher lows above the resistance. We want flips. We want patterns. We want bullish patterns. We want to see something that tells us, or we unfortunately have to afford to miss. Now, I've told everyone probably 100 times in chat that I use something called a psych position. In other words, I have psych problems. Unlike some of you who have been around a long time and you're built for risk, after my blow up in 2008, after doing 77% my first year and then totally blowing up in 2008, I became a scaredy cat of the market, afraid. And I wasn't built for gambling at all after that. I mean, I did some damage to my family. And so from that point on, I had fear about how to deal with the market. And that fear caused me to, in essence, make impulsive bad decisions and be afraid of putting on as much risk. And I definitely am not built to be a gambler at all. I don't have any of that in me. But I still love technicals, so I can make controlled risks. I can't increase my size too much, or I guarantee you I become blinded by the money, not price, and I lose the read. But knowing my failings, what I can tell you is I'll sometimes use what's called a psych position. That's what I call it. It'll be a situation where a breakout starts to occur. I'm worrying about missing it. It looks like a great stock to me. I felt left behind at that moment, and I'll put on a whopping 100 shares to mentally just say to myself, I'm in. Now, 90% of the time, I will lose on that position. 90% of the time when I do that, I will lose. Why? Because, of course, I'm chasing. It's fear of missing out. I don't want to miss it, and my brain is telling me I have to have it. And in order to quell that noise, I just buy 100 shares. I will lose on those every single time. It's very funny, but I almost always lose on that. It doesn't even make sense to do, but it's not about the money. It's about shutting down my brain that is telling me I have to buy it, I have to buy it. And that's telling me, dummy, you're missing it. It keeps going. I have to shut off that negative self-talk. And I do it by risking small money. Okay, so I'll lose $200. It doesn't matter to me. It's not even a fifth of a normal risk. Even on a smaller account, it's small. So I can do it and I can just get past that psychological issue. Pattern failures. Pattern failures exist everywhere. And I'm not going to show you pictures of pattern failures because we need to actually see them in action. You've seen me discuss the head and shoulders failure. You've seen me discuss a double bottom failure. But we're now going to start to get into next what charts look like that we actually have seen traded by me in chat. And so we've done a ton of slides, and it gets boring to actually talk about examples where they're not necessarily real trades that you've seen taken. So we're going to move on, but patterns fail. Double bottoms fail with a third bottom, and double tops fail with a third top or a breakout. And all of these patterns have their percentage of failure. The context is more important than the pattern. A double bottom that's small in a 5-year downtrend is going to get run over 90 out of 100 times. It's just the trend that's going to take it out. But a big double bottom over, let's say, 4 months that builds in a 1-year downtrend may be enough to turn price. So we use our skills and we realize the scope and scale of the pattern and that we use it. Now, I want to also remember to tell you what churning is. And I can't show this to you because we don't have a moving market in front of us. But you will sometimes notice that price will rally up to an area, even on a breakout, and the volume will just be streaming in, just absolute screaming up. You'll see streaming volume just flying into the stock, and price will sit right around the same price. This is called churning very often. And the reason this is happening is with all that buying, there's such a big seller there on that breakout, let's say, if it's a breakout. There's such a big seller. That seller's just standing up there, or multiple sellers are just saying, give them all they want at this price. We own this thing from the consolidation 8 months ago. Just give them all they want. They're all excited. The earnings are decelerating. Just hand it out here. And price will just sit there on massive volume. It doesn't mean you immediately exit your position, but you want to watch what happens next. Very often, the next move is either the seller will get out of the way, which finally changes, or very often the overwhelming interest and excitement will start to disappear because all that buying will lead to nothing. And so the weak hands will start to retract and pull away. And when they do, it will fall under its own weight. So you'll notice this at lows and highs. You'll notice a price go down, down, deeper down, and then fall straight down. And then price will have huge volume going off at the lows, and it won't be reaching any lower. And that's because buyers are just picking up all they can get down there, and all of the sellers that are trying aren't getting anywhere any longer. And it may take a little time and rest there, and then all of a sudden it'll start to lift. So it can reverse price. Just, I can't show it to you without a video. In fact, maybe during the next 60 days on the Twitter feed, I'll do a recording of when I see some churning occurring. But we can't call every time price stops a churning. It has to be massive volume going off with price literally holding and stalled at a certain area. Next one is exhaustion, and I've mentioned this throughout the class, but I want you to understand, I've explained how tops and bottoms have excitement or emotions or elation. Here's the chart for NTES. This has been a strong stock. We caught some of the moves on this. And beyond, now that you're starting to see charts, I'm hoping this far in the class you're seeing this topping resistance line. That's the reason this was kind of aggressive in here. And I want you to see the emotion. Huge volume bars above the topping resistance line, climbing up, big wide bars away from the 20 moving average because we're extended away from it, and then you'll see it rolls back. All of this volume was a lot of excited people. They're happy, they're feeling good. They're not necessarily reading price, but they're feeling good and excited. They're happy about their stock, their baby's running, and it doesn't go any further. Very common, as this is exhaustive. When people get excited or people get really afraid, these are how tops and bottoms form. They're a mixture between the size of the bars, the angle of the bars, the volume that comes in. That's why some people will say high volume is really good, but extremely high volume sometimes is the crescendo. It's the end of the 1812 overture, if you know that song, that symphony where they set off the cannons. That's the end. You know, that's the last of the climax, the excitement. So it happens on both sides. Emotions are at the highest at extremes, which are usually the largest bars and the highest volume. Note as NTES on this hourly chart, 1 hour, see it right here, drops down. There's not as much volume as when it finally gets to the low here. We start to see the volume ramp up down here. And this is the last of the people getting really afraid, saying, oh my God, I'm getting murdered. I have to get out. And they're wholesale getting slaughtered and throwing it out the window. It's interesting, you'll note that the next bar that goes lower, there's almost no volume now because there's less sellers now. They have been run out and scared out. And price closes low on one bar and then rips the other direction. This bar pattern, when you close really low on a big bar down and then you close the other bar the exact opposite, it is called a key reversal by Dan very often. And it's because you've been pushed one direction hard but no follow through occur and you jam the other direction. So while we're not really talking about bars fully here, we're more talking about reactions. This is the child hitting the stove with the finger and finding, can't go there. It's not that easy. And it's because all these people to the left right here have been decimated. So there's not many sellers left at that point. Buyers are starting to think it's worthy of taking a position. Now I'm going to mention relative strength, sectors, markets, the stocks. This is important. I'm not going to show you pictures because it's not necessary. This is the whole concept of what you read in the newsletter and Dan's Golden Rules, and the reason I asked you to read that book, How to Make Money in Stocks. Relative strength is strictly saying the behavior of this stock, what its strength is comparative to other stocks in the market. So I'm not talking about the RSI indicator because I don't use that. I do sometimes use the RS indicator, the relative strength indicator in MarketSmith, which many of you may use. But what it tells you is the strength of this stock compared to other stocks. So right now, while the market is hurting, and it's gone through a difficult period, we know certain stocks like MOMO or GIMO have had good earnings, are at the top of their chart. They have the highest strength relative to the others in the market. The highest relative strength stocks stay up when stocks are going down. The weakest relative strength stocks are the ones that are at the lows even when we're at new market highs. They're trolling the lows. So when we're trying to follow and enter in a trend, the easier trade should be the stronger relative stock along with the rest of the tools you've learned. Now, Dan only takes breakouts when he sees a market that's breakout quality and sectors and stocks. If you've read the book by O'Neill, you understand you put these together. When you're missing the sector and you pick the individual stock, it's easy for people to not get the whole story and the stock to retrace hard on you. You want them in a herd moving together. Like they say in Jurassic Park, they do move in herds. Yes, good breakouts and good strength to buy does move in herds. So if we're in a difficult market right now, and you're looking at a weak sector like bios right now are very weak, and the stocks in that group, even if you pick one that is strong, 9 out of 10 in that group are going down. The market is weak. Stocks are going down. What are the odds that even if you pick a good entry, that this stock is going to defy the odds of everyone else in the group? Remember, professional money is looking at the whole group in the sector and the earnings and the reasons for taking that, and they're not thinking, oh, this one is okay as much. They're thinking, hey, that whole group is kind of, in distribution. We can go over here and buy some stuff down here lower, and we'll amass a position over the next 3 years. They can do that. They can sit for 3 years building a position. You can't necessarily do that as a retail guy. And while they need to perform, they may have some hot stocks in their portfolio. They may need to load up a few names to have been moving the needle, but they can afford to sit on a stock lower and let it base for a long time. In fact, they can amass positions in weakness. But what you need to understand is if you're going to pick good trades, you want to pick what is, if you're looking for an uptrend, you want to pick what is generally acting good. If you're looking at 8,000 symbols and you're looking at the one that's one of the worst behaving ones, well, of course the signals don't work as well. Of course you have more hurdles. Of course it's more difficult. But if the market is difficult, and right now the market is difficult and steals are doing better, steals are stronger. There's tariffs going on for some reason. I don't understand fundamentals as much, but tariffs that are going on against China that stop them from dumping steel on the market at below market prices. So now that they've stuffed the Chinese back, all of the steel producers have a chance to make some money back and get back in business. Because of that, that sector is strong. Because that sector is strong, even though the market is not strong, I'm still playing MT, which is ArcelorMittal, in that sector and holding that stock because it has the sector and it's a strong stock in the conditions. So is X, US Steel. But again, I'm still missing one component that could have killed me on that trade. The general market isn't good. I know that when I take the trade. Now we're getting into real trades. So let's go over these and let's discuss them. Here's the CHK trade. I want you to see what happened. And now's the time to focus for you who have seen me call them what I saw that actually created the trades. We talked about head and shoulders. Here's a left shoulder, a head, and a right shoulder. When you drew the line across, you knew there was a right shoulder potentially right here. Kind of a bull flag, right? Flagpole, pull back, produced it. There was a long in here. That was not the long that I called live. Price rallies up, rising channel. Do you see it? It gets above the high, wider, looser bars, and a little bit of a rising channel, falls like a rock. Now the good news is it fell like a rock. That left no support behind really. I mean, there's a little bit right here, but it really didn't leave much behind. So when we're coming back up, there's not that much in the way. We get a tight triangle. We get a trend line between 1 and 2 pivots. We know where the trend line defense is here. We know this is resistance. We see the triangle pattern start to form. Now, next view. So before I go on to the next one, I just want you to know you have tightness, which means price is squeezing. Squeezing. Now, you're not noticing it yet, but there's another pattern here that I want you to understand that gives it even more strength. You may be seeing it and you may not be. Here's a left shoulder. Here's a head. That rising channel was a head. I'm looking here, and a right shoulder kind of develops low right here inside this triangle. It kind of creates it. And the resistance is this red line. And I see it take out that right shoulder area. So this swing is gone, and I'm thinking, man, this was a steep fall. There's not much in the way here in the way from stopping price. It's not going to hit its head on much. Price pulls back and makes a nice little descending trend line. And I'm thinking, if we get above $5 here and hold that, we don't break the low, call it 440 or 450 or whatever that is in here, we're going to go long $5. We've got tightness. We've got a failed right shoulder. There's not much in the way to the head because it fell like a rock. So our target is just the higher high. And this is how head and shoulders fail. We talked about once you take the right shoulder, you generally take the head. Well, the tightness, the pattern, the almost bull flag like, see them move up and then pull back and caught here and breaks the trend line. The trend line breaks and there's actually volume here. You can see 1, 2, 3, 4 nice green shoots. As this breaks through, I'm in at 5 and I'm targeting $8. Price rallies up. You can even see when it found support, it tested it, undercut it a little bit, and its reaction was right back to the top. It's a bullish reaction. That's great news. This is a flag area. Flat, flag, up, and then flag. Now, it's not descending like I like, but call it a little box. For those of you who have read Darvas, this is a little mini Darvas box. Price rallies through that, goes straight up. Now, this is the biggest bar. Notice this bar I'm on right now. I'm pointing to a bar. It is the largest bar of that move up, I believe. Remember what larger bars mean. Emotions. People are excited. It's rallying up. It does one more move. It stops and does an inside bar. That's at the edge of the top. That's called a harami. I don't know how they named that for Japanese, but all I can tell you is a harami is a smaller bar toward the edge of a big bar. And why does it matter? Well, because you can fake it. You can go above one side and then take out the other and fake people and trade off of the small area of that smaller bar. But in this case, it rallies above it and closes above that resistance. You're out to a new high. And I said, $8 we're here, sell it. Now, the next day after that beautiful close into new highs, it proceeded to gap lower and fall down. It created a small consolidation, tried to break out of the top of it. Look at that bar. Breakout failure, bear flag, breakout, falls down. Does it again, double top. It's a double top under high. What happens? Rejects off of the test of this top. Second top is a little higher. That's why it's a 2T. And the second top rejects and rolls down, breaks support, and now this stock is down toward $5 again. This move was about a 60% gain, I believe I made in my account on this move. I'm not as smart as some of the people in this class. Some of you have to teach me how to be more aggressive. One of the people in this class told me to buy options on it and made 575% on this trade. I did not. I made it from $5 to $8 and I got rid of it. Now, technically, I had a reversal signal. I admit one of my things is I don't try to get cocky with the market. If I have a beautiful winning trade and I try to be smart with the market and reverse, they kill me. I can't tell you what has happened to me in the past when I started to get cocky and said, long here, reverse here, go long here. I've gotten cocky and they come with a 2x4 and kill me. Now, I did it on Brexit. I called the short on the gap down when it lifted back up. I called the short. It fell back down to the bottom. I showed you that megaphone area, that bottoming support line that gave me a clue to start looking for a reversal clue. And I caught the long. I hate doing it because I generally lose control and lose money trying to get cocky with the market. I start to call it once, then twice. I start smiling. I know what I'm doing. And then I lose on the next street horribly. So I didn't call the short there. I simply said, I'm done. There were gorgeous, I use the word gorgeous a lot because I love how beautiful charts are. There was a bear flag followed by a double top under high with a 2T shakeout. There wasn't much more needed to figure out it was bearish at that point. This was a beautiful trade. SQ, this happened the other day right before the class. I posted to everyone on Twitter the example of this chart. You'll learn why it's important. And the reason you learned it was important is right now. And that is there was a gap on the stock. The rest of the market's acting terrible. This thing gaps up and holds the gap. You draw your trend line. It held it and then pulled back underneath it. I drew the support, which is horizontal. It undercut here. I like that. Somebody got screwed. It then tightened up and consolidated. Now you'll notice the day before earnings, or the catalyst that moved this, it closes at the low of the range. I'm sure people thought, it's not looking that good. Actually had high volume on the fall too. Kind of nasty looking, right? I don't think it looks nasty. I just see it as going back down to support. It's there to shake a few people. The next day on news, it gaps up to the top of the resistance level. It literally gaps over it and tests it right away. Now, is it the perfect trade? Well, no, it's right also up against a resistance line, trend line. So it needed a breakout. But literally, I probably, if I was paying more attention and I had more time and I wasn't working on the course, I would have gone down to a lower time frame and found an excuse to get long this on a 30-minute chart. Especially with a confirmed breakout on a strong stock like this. We had massive volume. Massive. I mean, look, this thing, it's double what, it's more than double what these average bars are. And you can see it's huge. And so here's your breakout. And this was a gorgeous stock from 11.25, call it, to I believe it's over 12.50 now or more. But the end result is this is the stuff we're looking for. We're looking for that screw bar. People thinking it's going to go one direction, they rip it the other direction while nobody can figure it out. And the goal is to leave people behind. The market is an engine of destruction. Its goal is to take out the weak hands. Its goal is to fleece the people who don't know better. Now, here's another trade. I'm going to go to the Russell. This trade was very, very, very clear to me. I was able to call the top on the market using this and a couple of other charts. This chart was a weekly chart. And so we're looking at, this is the Russell 2000. I use the ETF TNA. Now, I'm drawing a trend line from number 1, 2, and there's a third test. So it could have been a trade, but let's forget that for now. Let's simply call that a downtrend line. And you can see I already was thinking left shoulder. It's double top over here, kind of, and a head. And I drew it, and price gets up there, and the alert goes off. I notice we have an uptrend line, and I duplicate it to the top, and it's the top of a rising channel. Now, when it gets over the top, we know that's really overbought, and it's hitting an important line here to create the right shoulder. So I knew this was a short area. Now, in chat, I called this short, and there was a reason why I called the short, and that was because I could tell that price was topping out here. There was a rising channel that formed, and price came up to retest. We have like a double top that forms. Price flipped support to resistance, and it was all she wrote. This was a top. I actually caught TNA, the Russell, from $93.50 on TNA, I believe, to $62. Next one, LN. This was one where nobody wanted to listen to me on that it looked bad, but you have your two topping lines. You drew your topping resistance line, your TRL. You duplicate it to the bottom here, and this was a short. I believe it gapped and I didn't get to take this. This was one I called and didn't get to take. It rallied up back in, and the next day I had noticed it when it was already down further, and it was a breakout on high volume as it fell. And that was a short. I believe this was definitely one I called, but I definitely did not get the position. ACIA. Now I did call this very specifically. We had a top. I mentioned it. I actually sold out in the high 120s, 125 maybe. I don't remember exactly, but there was a rising trend line, a support trend line, an uptrend line here, and I noticed when it had flipped via gap. Now look, there's a trend line here and a trend line there. Island gap reversal under there. This was a short. Here's that exit signal we just talked before. This was a live call, a top on the double top and the topping resistance line for Momo. This was while everybody was calling that the stock was gorgeous. I was calling for it to reverse. Oh, here's that TNA short. Here it is exactly. This is the Russell 2015 top. There's a resistance level. There's a rising channel. Price reaches over. This is incredibly overbought here. And then reverses. You'll notice the bar on the next day. It literally gets over and it falls like a rock, closes underneath it. And then price falls to the bottom of the channel. And this should be support right here, but it breaks it, goes underneath it, and rallies up. So now you're thinking, what's going on here? Maybe it's holding this support here. Maybe it's a double bottom shakeout in here or something. And it comes up to the prior uptrend angle. This is now a support line or a demand line here, and it turns it into resistance. It goes for 2 days sideways, pokes above, and then sells off the next day. And I knew it. I had shorted this at 93.50 live. I talked about the trade for, I think, 2 days. And we shorted. I did not cover when it undercut here. This was the first target here. So there was a little taken off here. I had believed that we were flipping trend. And it was very clear to me. It lifted up, lower highs, no bother here. Breaks the support here. Look at the trend line. If you had drawn a trend line here, you could have said to yourself, if it breaks out on volume above that line, I'm nervous. But until such time as that happens, forget it. I know it's going down. There was no even attempt to break out. Even though it's wedging here, you kind of see the lows here and the descending trend line here. There was no attempt. Never attempted. Kept going down. Now we get into wider bar, wider bar, wider bar, bigger volume. What am I thinking? Exhaustion. Exhaustive, climax, the 1812 overture that we joked about before. I closed out and covered up at $62 live for chat. This was an enormous trade for a lot of members because it was the top of 2015. Here's another view of that, and I want you to see how layers add up. This was also a left shoulder, a head, a right shoulder, and no breakout attempt above that trend line. Yeah, there was the live cover. I actually set it at 62.50 to be accurate. I thought it was 62, but it was 62.50. And you can see the volume explode as it comes down this final. This is pure fear. Excitement shows up on the upside edges, but this is pure fear. That's why you're seeing the massive pop in volume. But again, no attempt to leave the pattern to try to go and go up. So I was completely comfortable holding through into the crescendo as it fell straight down to $62 range. Next one, another TNA short. This was a clear resistance line that I remember drawing, and people asked me what I thought about the market, and it was coming up. It was actually looking strong to most people. I remember this, and there was a rising trend line, and it was an easy short. It was just short here, stop over the top of the pattern. And literally, when it fell, this thing created a test that was two lows, and it was sideways in a pattern. I knew that was a bear flag. Once I saw those first two lows, I drew the trend line, duplicate it, and start looking for the top edge. And this was a bear flag, another bear flag, and you can see the fall from that. So that was another short call on the Russell. This was a live long here. You can see it started out with a double bottom here. I didn't catch this, but you can see the reaction. It undercut, and look what power shows up. Momentum shows up because they screw people. then it rallies up hard, rising channel. You know that I feel that rising channels will resolve to the downside at some point, and it does. It cracks down, it finds dual support here, and it finds the bottom of that descending channel. Right here, when it breaks out of that, I said to myself, you got the backing here, you got the backing here, you got the reversal here. It was worth a long. This produced a nice rising channel trade, but it ended by a sharp break, and it was over with. Very good trade. This was live. Here's another live mentioned trade that I had talked about on the Russell. I did a lot of trading in 2015 or recently trading the Russell. It was very clear to me, and I always stick with what's clear. You'll notice the same charts again and again. When I can read it clearly and the reactions are so easy for me to read, I stick with it. Why? Because why do I need to go and test when I have a place where I'm making money 70% of the time that I touch it? I don't. I don't have to fight. I just keep doing what's working for me. That's unfortunately why I spent too much time on Twitter. And Dan, corrected me and said, Randy, don't put all of your effort into a dog. And he was right. I could have made more putting in that effort and managing that mastering on a good chart that kept going like crazy. Now, this trade was pretty simple. You can see there's rising channels and reasons why these corrections occurred. But a simple trend line showed this shakeout. Next day, back over the line. I know people are screwed. Powerful move ensues. That's it. Very simple reasons. Now, I probably had 3 other reasons on a lower time frame when I went to enter. I always try to stack my layers. Here's a recent short on the S&P. People asked me what I thought, and I called this short live. It was pretty simple. Just recently, this is an hourly S&P chart. I didn't use the futures to see this. It was in the real-time chart that I found it. But you'll see prices squeezing. You've got your sellers, you've got your buyers, and then suddenly the buyers flip to sellers right here. And look, one peak, higher peak. That's a 2T. It's a double top under the trend line. It was a short. I made money down to, I believe, what I thought would be the right shoulder or something that I thought it would be, and I didn't. I took out a portion of this trade at the first target, which was 5 times my risk, which my risk was peanuts. It was nothing, and it hit down here, and I got my 5X. And then I believe, I'm trying to remember, I don't have the best memory on trades because I do so many at times, but I believe I got stopped out on the remaining on this trade. Next trade. This was a live long. Nobody could figure out in chat why I was taking the TNA long at the lows. People were confused, but I will tell you there was confluence there. It doesn't work without layers. I had a supporting area. Price had lifted up and rallied. I drew my downtrend line. I copied the line. Actually, this should be 1, 2, 3. But I drew the underline, and it pointed right to here. That also was a virgin mid, and that also was a gap fill. So you see gap fill, virgin mid, bottom of a descending channel, shakeout on the bottoming support line, BSL. I bought it. It went up to the top of the pattern, shore up my position, know that I'm kind of pushing it, and this is a lucky break that I'm not going to go and only, sell 20%. I sold like 80% of the position, and I believe the other 20% I totally ate back at cost. Not uncommon for me to have I call my last exit the moron exit, because I always feel like a moron on the last exit because I'm trying not to kill the move. I'm trying not to collect peanuts. That last exit always seems to be me with my tail between my legs. Next one, this is another SPY hourly chart. This is the chart before this double top we saw here. There was a gap down, and I remember seeing the descending line, so that becomes a reaction to read. So does this line. It didn't break down. It broke over here. Volume came in. This was a long from a breakout standpoint. I knew the target zone was once you start getting into this top, it gets into the gap. It may fill it, but this spike area here would be trouble. It rejected it. You hit your 5-to-1, you get out. The remaining that you left, the 20% or whatever that you left behind, toast. You eat it. This is the Brexit live long. Very simple. The chart had a downtrending resistance line, your downtrend line. One peak, two peak. Notice that the close is underneath and it's the wick that's above. Notice here, wick above, close under. Notice reaction on the last one. Wick above, closes all the way down here. They just threw it back. That was the hottest stove ever. Shot it down. But what's important to realize is these reactions tell you they're fighting, and these are breakout failures. Can't get out. Weekly chart. We're looking at a weekly chart of the S&P futures. Now, I draw my lower edge. I only needed 2 pivots, 1, 2. They confirm it on the week before. So I knew where the low was confirmed. I knew the area mattered. The next week, it undercuts that level, and I look for other clues. I believe down there was a small consolidation. There was a flip. There was also a small double bottom on a short time frame, but I added up my reasons. That's how I find a trade, is add up all of the factors together. Now, you may be saying, well, Randy, when are you going to get to teaching bars? But you've been learning bars by the reactions that they do. You're not learning necessarily the names of them, but we can tell you what they are, and I can show you some books to read or look at that discuss the names of bars. But I have to tell you, the names of bars that they tell you in these books that are positive, they'll say, oh, a hammer is positive. This bar right here is positive. The long up bar closing at the high. Big wick. And they'll say, that's fantastic news. Problem is, it all matters where it's formed. If this happens at the top of the range, if this happens right up here, who says it's going any further? Here's a hammer, all wick, closes at the top of the range, never goes anywhere. It's location. People will call and say an inverse hammer, where the bar closes on the absolute low. Here's one that absolutely all wick closes on the low. They sometimes call it a gravestone doji. Okay, well in this case, in this context, it broke such a big level. It may have not gone anywhere, but it did. In this case, it broke lower. Context is still more important than what the name of a bar or candle is. What we're looking for is to read what the reaction tells us. Is it pushing it away? Is it throwing it back? Is it holding near it? Is it popping over and then falling back and rejecting? We get clues of the breakout or fake out or shake and all of that by the reaction. Where the close is comparative to the rest of the bar is a good indication. So this was a breakout failure area, and this is how I call the long on Brexit. And I believe that long was good for 225 handles in the NQ futures. I had a good time with that trade. Another view of Brexit, I just want you to see. Here is the topping resistance line, gave you the top of the market on the hourly S&P. So you knew where the S&P had lifted to. You then had a support line or a demand line. It flipped that as resistance. There are your 2 peaks. That's a double top under the line. It actually created a line uptrending, a rising wedge that I just show is red because it's a bearish pattern. It popped the top here, and I just want you to see that. Look at the gap that happened afterwards. These people are trapped. The thing went straight down. Sometimes the trap, you just can't see it in time. Some of them you catch, some of them you don't. But note that the market is looking to screw people, and when it does, you get fast, beautiful, big moves. Next one, ACIA. Here's a live long. We talked about this trade. I showed you multiple reasons for prior trades in ACIA, but here's another long. This was an earlier long at the low. Dan had caught it at 32. I never caught it at 32. I caught it actually on the bigger pullback to like 36 later on. But here's a support area, and look how it tightened up in a triangle. Look at the inside bars. The next bar is completely enveloped inside the previous bar. The next bar is completely inside of that bar. Think of that as like squeezing. The bars are inside, the bars are inside, the bars are inside. It's kind of like volatility is being squeezed. When it finally leaves that range, you could get a powerful move. Well, your stop is the lower green line and your breakout is the upper green line. It's fractional differences, very small risk. So 5 to 1 may have only been right here. Very tiny risk. The stock flew, I made some money. It actually blew off and it lost support here and I sold it, and then I bought it back, I believe, I want to say 36. Now we're going to go over this long on Acacia or ACIA. This is an hourly chart. You can notice it right here, hourly. And you'll notice there was an uptrend line here, triangle. Look how it breaks out below it. There's your fake shakeout and rallies up. Price goes down, there is a resistance line. It creates a left shoulder ahead, and I'm looking on this trend line, this uptrend angle, for a right shoulder. This is common behavior. I'm giving you a major hint about price. When they fail a trend line and shake out, they will often tap it from the other side and flip it back as support. But you can see the reaction. It does a key reversal bar. Closes on the low, next bar smacks back up support line, and this starts the pattern. This was a live long that I took. I had called it here as well, but I also took a live long here, and this was an uptrend line retest as support, a right shoulder of an inverse head and shoulders pattern which held. So we had multiple reasons why. Now the next important thing is to notice the behavior after the entry. You'll notice it goes up making kind of a flagpole and then a consolidation, kind of like a flag, but it's not really. This is a consolidation with a small descending line. And it's tight, it's squeezing together. There's two pokes here. That's a double bottom on another time frame. But we're looking at hourly. I don't really go much lower, maybe a half hour. So you got a double bottom there. And it rallies off of it. We get volume that confirms it. I have no reason to sell. Price rallies up kind of exciting over this high to the left. And you can see it kind of rejects here a little bit, but when it tries to break the uptrend line, look what happens. No follow through. It makes it one close underneath, next one, same close level generally, and it gaps up. No reason to freak out. It's not taking out the swing lows. It's no problem here. Then price starts to rally up here, and you'll notice rising wedging behavior. We know that generally leads to a break, and it did, but it doesn't break any distance. It holds up. This trade gave us very little trouble to stay in, and that's the point of is to try to also read the behavior afterwards. Now, instead of learning the names of bars and calling them things, realize the behavior of the bars at these key points. Descending trend line breaks, right shoulder of inverse head and shoulders, consolidation patterns, the behavior coming out, the breakout, the uptrend line holding, the topping resistance line, and the bottom support line, which is steep, which means a break is even more clear usually because there's less support built. You need to see all of these things to understand what price is telling you, and it's more important than a name of a bar. Here was win. These were patterns that, and this is generally how I trade. So an example is we'll get a triangle behavior here. These are sellers, these are buyers. It falls lower to support. People will be negative on it. Undercuts just slightly, gets stronger. I see it kind of break out of this flag area. So this is a long for me as long as the distance is small for the stop, which it was, but not really 5 to 1 there. Then this is the Dan type of entry. You get a breakout. Price holds a new demand line, starts to flatten out, which is very often what happens. You flatten out your trend lines as things calm down and momentum loses its strength, and it gets caught in a base. Here's your breakout failure we talked about before, and this is a range. Here was the live call on Tesla. This was pretty interesting. We had an uptrend line here. I did not take the counter trend signals. Can I trade counter trend? Sure. I can explain to you reasons for it, especially on this one where not only did it see it, it engulfed the whole prior bar, telling me that they saw this uptrend line. But I suggested to take the short instead because the trend is down at this moment And it was easier to look at number 1 and 2, draw the topping resistance line, and find a short here. I missed this short, but this one worked. And you can see this one was even better because, well, better and worse. If you knew where support was, you knew it was right here. So you didn't necessarily have the 5-to-1, but once you hit that uptrend line and you gapped underneath it, remember, a gap is an instant flip of support and resistance in many cases. It gap flips the uptrend line. So it's bearish. So this was an easier trade getting down to this next support, which it even overtook that. Bears are showing power breaking these support lines. Here is an example of trading off of a simple trend line. This is for the investor. I'll give you warnings. I did these all live where price went over the top of the rising channel. And this is overbought on the first white arrow. And then it created a really tight channeling. And when it broke it, that's a rising channel. This was not a short call, but this was a sell it call. For an investor, it comes underneath the uptrend line. You have 1, 2, 3 pivots. Right here you have a long. It comes back and undercuts it. And this is where they fleece traders, and I always make the comment, just when you think the trend may end, bet it won't. And in this case, it created a beautiful long off the rising channel, and that was a live call. The reaction was fantastic on that trade. You can see there was another break of a small descending here. You can see how tight the bars are here. When it's tight, I'm excited because it means I can control risk even better. Goldman Sachs, here's an example of a problem trade for me. I actually bought this and it failed on me, and I read it after I lost on the trade, which I have losing trades at least 30% of the time. But here is an attempt to break out that fails right here. Price finds a new level of support, finds a new level of resistance, and there is no attempt to invalidate that flip. It actually does not break out ever, and it goes underneath the support and hangs below it and falls lower. This is a resistance flip from support. Here was your support, now your resistance. And so the move is down. Here's a quick support test lesson. I just wanted you to see this is very common in the market. You will have all your supports drawn out. You will be so clear about how important a level will be. Price will undercut it slightly and build the pattern right underneath. This is normal and happens all the time. It's to screw traders. I will notice the best double bottoms and double tops that form right after they've mauled everybody out of the swing low area. This is a good time to end this video. The next video will deal with how I set up my screens and exactly how I see stocks and charts throughout the day using a watch list and what tools I use. But it's a good idea to stop here and roll back and keep reviewing until you understand these chart setups. Otherwise, you won't find value in the next material.